All right. Thank you, Jermaine, and good evening to you and your fellow committee members and everyone tuning in online. In this part of the session, I will introduce the concept of asset classes, identify the main classes, and briefly state their benefits for investors, as well as their limitations. In finance, an asset class is simply a group of financial instruments or investments that have similar characteristics and behave in a similar way in the market. There are 6 main asset classes, which include cash and cash equivalents, bonds, stocks, commodities, real estate, and alternative investments. Each of these asset classes has unique features such as risk and return characteristics, liquidity and volatility that distinguish them one from the other. First asset class, cash and cash equivalents. These are highly liquid assets such as bank deposits, government treasury bills, and money market instruments, for example, repurchase agreements, which provide little to no price risks and consequently offer relatively low returns to investors. The main benefit of cash, however, is if you deposit money in your current or savings account, for instance, you know it won't be exposed to market volatility. So when you need access to it, the cash is there. Because of its ready accessibility, cash is often seen as safe. So it may be a good asset class to hold wealth if you need immediate access to it, are building an emergency fund, or have short-term goals. However, one drawback is that once you consider inflation, the value of cash may fall in real terms. For while you may earn interest on cash deposits, it's unlikely to match the rise in cost of living. So gradually, what you can buy with your cash will diminish, and it gets worse over the long term. Therefore, if you're saving for long-term goals, other asset classes may be better suited. One such asset class is bonds. Bonds, also called fixed income securities, are a popular asset class among investors who are looking for higher returns than cash and a stable source of income with a relatively low risk. Bonds are debt instruments which are issued or used by governments and corporations to raise financing for various purposes. Governments, for instance, may issue bonds to finance their budgetary expenditures, while a corporation may raise money from a bond to expand its operations or fund new business ventures. Borrowers or issuers of bonds have an obligation to pay their debt as well as make periodic interest payments while the debt remains outstanding. Bonds are generally regarded as medium to long-term investments, but can have any tenor ranging from 1 year to in perpetuity. Bonds that have tenors from 1 to 3 years are called short-term bonds. Those that mature in 4 to 10 years are regarded as medium-term bonds, while those maturing in excess of 10 years are classified as long-term bonds. Additionally, a bond that has no maturity date is called a perpetual bond. Other terms associated with a bond include face value, coupon rate, callability, yield, and credit ratings. When investors buy bonds, they are technically lending money to a government or corporation, and that borrower promises to repay the principal amount of the loan plus interest over a set period of time. The face value of a bond is therefore the principal amount that is repayable at maturity. The coupon rate or interest rate is the rate at which the issuer or borrower pays periodic interest to the investor, and the interest rate is usually fixed but can also be variable or floating. Some bonds are callable, which means that the issuer has the right but not the obligation to pay back the bond before its scheduled maturity date. And since perpetual bonds do not have maturity dates, most of them are issued with call dates. The yield is the annual return on the bond expressed as a percentage and is determined by the bond's coupon rate, its maturity or call date, and the price the investor paid for the bond. The credit rating of a bond is a measure of the issuer's creditworthiness and ability to repay its debt. Credit rating agencies such as Standard and Poor's, Moody's, and Fitch assign credit ratings to bonds based on the issuer's financial strength and other factors. The coupon rate offered on a bond is often influenced by its credit rating, as investors usually demand relatively higher coupon rates for poorly rated bonds to compensate for the increased risk of default. One of the main advantages of investing in bonds is the stability of the income stream they provide. Unlike stocks, which pay dividends that can fluctuate based on the company's financial performance, bonds offer a series of coupon payments for the duration of the bond. This makes bonds a good choice for investors who are looking for a predictable income stream to fund their retirement or other long-term goals. And although bonds are typically regarded as medium to long-term investments, most bonds can be sold at any time before they mature on what is called a secondary market. In doing so, an investor may end up selling the bond at a higher or lower price than it was paid for, and therefore realize a capital gain or a capital loss. However, selling at a loss doesn't necessarily translate into an overall negative return for the investor, as the total coupon or interest payments received while the investor held the bond serve to offset any capital loss. On the other hand, selling a bond at a profit helps to boost overall return. So, unlike cash, bonds are exposed to price and default risks, but they are generally less risky than stocks and therefore offer potentially low returns as a result. This takes us to the next asset class, stocks. Stocks, also called equities, are popular among investors who are looking for long-term growth and potentially high returns. Stock represents ownership in a company, and stock investors are regarded as shareholders who have the potential to benefit from the company's profits and growth. Stocks offer the potential for capital gains and or dividend payments to make a return. If you sell your shares for more than you pay for them, you will book a capital gain or profit. Conversely, if you are forced to sell below the purchase price, you will realize a loss on your investment. Additionally, some stocks pay dividends, which are regular payments made to shareholders out of the company's profits. And like coupon payments on a bond, dividend payments can provide investors with a stable source of income. However, unlike bond coupon payments, companies are not obligated to pay dividends, and many companies actually don't pay dividends at all. One such company is Amazon. In such instances, therefore, an investor solely relies on growth in the company's stock price to earn a positive return on their investment. You can buy and sell stocks on stock exchanges such as the Jamaica Stock Exchange, the New York Stock Exchange, and London Stock Exchange through licensed brokers. Stocks also require smaller amounts to invest in than most bonds. For instance, you may be able to spend as little as $100 to buy a stock depending on its price. But for many bonds, the minimum amount required will vary from $1,000 to several $100,000. Historically, stocks have outperformed other asset classes, such as bonds and cash, over long periods of time. However, stocks are also subject to more volatility and risk of loss than bonds or cash. Next, we have commodities. And the commodities are raw materials or primary agricultural products such as gold, oil, wheat, and coffee that are traded on commodity markets and offer potential for diversification and protection against inflation, as their values tend to rise when inflation is high. The value of commodities is also heavily influenced by supply and demand considerations, driven by factors such as changes in weather patterns, geopolitical events, and global economic conditions. This makes them more volatile than other asset classes. Additionally, whereas some commodities, such as gold and oil, are highly liquid and can be easily bought and sold on the market, others, such as agricultural products, may have lower liquidity and be more difficult to trade. Also, unlike stocks and bonds, investing in commodities may require physical storage, which means that storage costs can be a significant factor in total return on a commodity investment. Overall, commodities offer investors the potential to hedge against inflation and geopolitical risk, but they also carry a higher degree of price volatility and market risk than other asset classes. And unlike asset classes such as cash, bonds, stocks, and real estate to come, commodities require appreciation in their price to provide a positive return to investors. Next up, real estate, which is a popular asset class that represents physical property such as land, buildings, and homes. It offers investors the potential for both income and capital appreciation, making it an important consideration for long-term investment. Like commodities, real estate is a good hedge against inflation as its value tends to rise with inflation. And when real estate values increase, it provides investors with the potential for capital appreciation. However, real estate investments can be very illiquid, meaning that it may be more difficult to buy and sell than other assets, such as stocks and bonds. This can also make it more difficult for investors to adjust their portfolio quickly or take advantage of market opportunities. Acquiring and disposing of real estate may also attract significant costs and fees, which can meaningfully depreciate the overall return on the investment. In addition to the potential for capital appreciation, real estates can generate income through rental income or leasing arrangements. Overall, real estates offer investors the potential for longer term growth, income, and diversification, but also carries more market risk and illiquidity. As with any investment, it's important for investors to carefully consider their goals, risk tolerance, and investment horizon before investing in real estate. Finally, alternative investments are investments that do not fit into the traditional asset classes previously mentioned. These include such things as hedge funds, private equity, venture capital, and cryptocurrencies. Alternative investments offer the potential for high returns, but also come with high risk and less liquidity. That said, an asset's liquidity does not speak to its return potential. It only means that it may take more time to find a buyer to convert the asset into cash. In concluding, each of these asset classes has its own characteristics and risk profile, and investors often choose to diversify their portfolio by investing in a variety of asset classes. I will now turn over to Dwayne, who will speak more about diversification and its importance in investing.
Hi, Dwayne, you're muted. So, yep,
Oh, sorry about that.
no problem.
Good evening again. All right. So I was looking in the chat just now and I saw somebody say the comment was equities all the way. Which fear, that's your personal decision, but you can also diversify within that asset class. So Eugene spoke about different asset classes. So I will now take us through diversification, what diversification is, and also some of the benefits of diversification. So diversification, it's a crucial concept in investing. It involves spreading your investments across different asset classes. The idea of diversification really is to reduce your risk and also increase your returns, the returns that match your risk appetite. So the concept, like Jermaine had said earlier, think of it as not having all your eggs in one basket. Let's say you go grocery shopping, you buy 3 trays of eggs, you get home, unpack in the car. If you take 3 eggs into the house, you trip and you fall, then it's likely that all those eggs will break. If you were to make 3 trips, 3 separate trips, bring in 1 tray each, then it's likely that you'll still have 2 trays when the ordeal is done. So one of the key benefits of diversification, like I said, is to reduce risk. So by investing in a variety of assets, you reduce the impact one investment will have on your overall portfolio. So for example, if you have all your money invested in the stocks of one company, and that company should get into any financial downturn, then it is likely that your entire investment portfolio will lose value. So what you want to do, two things: you can look to diversify within the asset class of equities or of stocks by buying several companies in that basket, or you could look to buy equities and also buy into other asset classes to diversify. So diversification can be done within the asset class, or it can be done in different asset classes. So the goal really is to reduce your risk. So with diversification, you're looking to not only invest in various asset classes, but within, you want to invest in different industries, different sectors, different geographical regions, and these all play a part in reducing your risk and your exposure to just a single investment. Diversification also helps you to achieve more consistent returns on your investment. So different asset classes tend to perform differently given different market conditions. If we remember, let's say, what's that, about 5-6 years ago, the Jamaica Stock Exchange was the best performing in the world. Everybody wanted to buy stocks. Stocks are up globally. Stocks are doing well. Bonds wouldn't have been performing as well at the time. But fast forward to 2022, 2023, the stock markets are down now, given various market conditions have changed since. Stock markets have been down, some are on the rebound, but bonds have also been doing much better. So what you'll find is, given different conditions, different asset classes can perform differently. So having a diversified portfolio across different asset classes allows you to be more consistent in your returns. So during one period, your stocks will be up, will be earning for you. In another period, the bonds may be up and earning for you. So it's good to have that level of diversification to allow for that consistent return and help you to achieve better results over time. Another benefit of diversification, it allows you to take advantage of different investment opportunities. So by investing in different asset classes, you can access different markets, different industries that may offer higher returns and even lower risk than your current investments. So, for example, if you only invested in local stocks, you could be missing out on the simplest thing: buying stocks in other markets, buying stocks in the US, in Europe. Because you're only concentrated here, you forego the advantage or the potential gains that you could be making in those markets. Likewise, if you're only investing in local stocks, you could be missing out on earnings from bonds, real estate, any other asset class in any other region. So it's good for you now to look beyond just your current asset class or beyond one asset class. Have a wider scope when looking at investments so that you can take advantage of the opportunities as they arise. Diversification, it also helps you to manage your emotions as an investor. Many of us would have seen our stock portfolios looking very good a few years ago. We were confident, we were happy, we were quite relaxed, seeing the portfolio values going up, up, up. The truth is, when these start to come down, if you're only invested in a single asset class, when these start to come down, your overall portfolio starts to come down, then emotion tends to kick in. Emotion tends to take over our thinking. It takes our focus from what our investment goals and objectives were. We're no longer remembering that, okay, this is for our kids' college fund 10-15 years from now. We're just looking at the fact that, okay, I now have less money than I did a few years ago because the value of my portfolio has fallen. it may cause you to make an irrational decision to decide to sell the stocks that you have now to look for new stocks or look for what the hot stock is at the time to try and recover that and to earn enough to still meet your goals. But the reality is, if you take that emotion out of it, because having a diversified portfolio, if the stock portion is down, the bond portion is performing well, you won't be as inclined to make that irrational or emotional decision to sell or liquidate an investment to move into another, because you now understand and just not seeing your portfolio value plummet as you would if it were you had only invested in one asset class. So, this helps to take the emotion out of it. It also helps you to stay focused on your goals that you would have set upon making your initial investments. Finally, diversification can help you to achieve your financial goals by balancing your risk and your return expectations. So every investor has different goals. Each person has a different risk tolerance. We all have different time horizons for investments. So being someone may be more risk averse, they may prefer low risk assets, bonds or cash equivalents, so things that can easily be liquidated to get cash, and that's fine. Other persons may have a higher risk tolerance. They may seek higher returns. They may be more aggressive, and they may say, okay, I don't want to diversify outside of a single asset class. I want to stick to this asset class, but still within that asset class, it is important to diversify to ensure that if something does happen to negatively affect your investment, your overall portfolio is not going to be affected. So it helps you to find that balance of risk and return that matches your financial goals and your personal preferences. So diversification is a very critical concept in investing, and it does help you to reduce risk, achieve more consistent returns. It allows you to manage your emotions, balance your risk and return expectations. So while it doesn't guarantee profits or protect against losses, it can increase the likelihood of achieving your long-term financial goals. So it's important to diversify across different asset classes, industries, sectors, geographical regions, and this will help you with your risk tolerance. It will also ensure that you stick to your time horizons, and it can help you to create a portfolio that's resilient and can stand the test of time given different market conditions. So I'll close there. If there are any questions, then I'll ask Jermaine to take over.
All right, cool. So we're actually going right into Q&A now. So I'll bring back on Eugene as well. So what we can do here, I thought, before we take general questions, I'll just ask a few persons were asking, for example, about a broker. I just want to be clear. Just share again, the services that you offer at Sterling, and what maybe terms of engagement are for persons to work with you. So just speak to that before we get into any specific questions.
Okay, so Sterling Asset is we focus on US dollar fixed income investments. So primarily bonds, corporate notes. We don't do local equities, even though we have a company that's listed on the Jamaica Stock Exchange. That's Sterling Investments Limited. Yeah. So you will see, or you may have seen Sterling Investments in your research, or some of you may own it, but that's just a part of our overall company. So Sterling.
So if somebody purchases Sterling Investment Limited that's listed,
right,
is it that they're getting exposed to whatever you invest in? Is that the right way to look at it?
So think of Sterling Investments as let's say, and basically an ETF. So it's more of a managed portfolio that has been listed on the stock exchange.
Okay.
Yeah. So we are listed, so you are able to buy stocks in sterling investments. But for sterling asset management, our focus really is on US dollar fixed income products.
Okay, so for someone looking to get exposure to those particular assets, then you would be the person to talk to, as in sterling.
Correct.
Okay, cool. All right, what would it take for somebody to open an account with you? What's that process? I mean, can assume it's standard, but just for those who would like to hear explicitly, tell persons what they would need to open an account with you. Is there a minimum deposit required? Things of that nature.
Okay, so for opening an account, it's pretty simple. The minimum requirements really are ID, government issued ID, TRN, which the driver's license would cover both. Uh, Current proof of address, so a utility bill issued within the last 3 months, or a bank statement can be used. And apart from that, really, the minimum opening is 10,000 US dollars for most of our products. The only exception being our mutual fund, which is the opening amount is 1,000 units at the current market price. So
Okay.
yeah, so the current market price is somewhere about $7, between $7 and $8. So it would work out to, let's say, 8,000 US dollars to open to get into the mutual fund at this time.
Okay. And persons can find out about all of those funds and options that you're speaking about on your website, or they would have to come in and speak with you to get the detailed information.
Well, it's all listed on our website. The website is www.sterling.jm.net.
Okay.
Right.
All right, great. So I want